Welcome, everyone, to today's webinar. Happy that you're able to join us today. This is the first one for 2026, and as always, we have a great webinar in store for you. A lot of great information. Appreciate everyone sending in their questions ahead of time. That helps us with structuring the content that we're going to cover today. And also, we'll cover questions in future episodes of our podcast as well. So during today's webinar, if you do have any questions that pop up, fill out, there's a little chat feature. You can submit those questions through there, and we'll do our best to answer them as we go through the presentation. But if not, we'll cover them, as I mentioned, on a future podcast. So today, we're going to talk about the new tax bill. And, there's been a series of tax bills that have been passed over really going back to 2017 with the passing of the Tax Cuts and Jobs Act. That's where, we really started to see, a lot of these changes that they continue to morph. So we had the Tax Cuts and Jobs Act at the end of 2017. Then we had the Secure Act 1.0. Then during COVID, we had the CARES Act. Then kind of still in COVID, we had Secure Act 2.0. And now we have the one big, beautiful bill that was passed last summer. So, again, a lot of little kind of changes throughout that entire period, but definitely things that impact all of you that are on today's webinar. So, hopefully, there's some education here that you get something. There's a lot of clients of Keen Wealth that are on today's webinar, and I can tell you your planning team is looking at all these factors for you. But if you're not a client of Keen Wealth, we definitely have we do have capacity. We continue to expand our team, and we have availability to sit down and go over how this would impact you, because that's really, there's so many little kind of pieces to it, and it's very difficult to evaluate one of these components in isolation, because they're interconnected. And throughout the year, I host many different webinars, and we also have our podcast that we publish every other week throughout the year, where we're talking about different concepts, and whether they're new tax law changes, potential tax law changes, what's happening in the stock market, but also how these interconnected pieces all impact each other. And really the best way to evaluate that for you is to evaluate what it means for your situation. So again, hopefully you learn a little bit here, and understand kind of what we do here at Keen Wealth. We're a fiduciary retirement and tax planning firm headquartered here in Overland Park, Kansas, but we have clients all across the United States. So, if you're not local to us, that definitely is not a problem. We can work with you in any capacity. As I mentioned, our podcast on it's called Keen on Retirement, comes out every other week, and then in between those weeks, we have a blog that accompanies that podcast, and we're posting the videos on YouTube as well. So subscribe to our YouTube channel, check us out on any of those podcast players. Keen on Retirement is the name of it if you'd like to look it up. Go to our website if you haven't been there, keenwealthadvisors.com, and you can you can subscribe, get on the email list there as well. Also, our founder and CEO, Mr. Keen, he is the Amazon best-selling author. He's out with his second edition of his book, Keen on Retirement, Engineering the Second Half of Your Life. If you'd like a copy of the book, send me an email, mwilson@keenwealthadvisors.com. Happy to get a personalized copy sent out to you, at no cost. At our expense, we'll cover that cost for you and get that sent out. Okay, So we've got the new tax law that passed last summer. And, I think it's also good to talk through the various changes that happen with Social Security and Medicare. Some changes are, a legislative change where there is a more significant change. Others are, I would say on autopilot, where there are, built-in mechanisms that adjust how Social Security is, is adjusted, whether it's the cost of living increase, whether it's the earnings threshold if you're still working and claiming Social Security, how the taxes of Social Security work. There was a lot of, a lot of discussion during the presidential campaigns. Both the candidates were talking about no tax on Social Security, and still kind of questions around that, because they did allude to that, I think, in the passing of that new bill last summer. But we'll cover how that works. And then, of course, Medicare. Once you're age 65, eligible for Medicare, then there's a whole plethora of choices that you have along with that. And Medicare, has similar kind of escalations every year, whether it's the premiums that are increasing, but also these thresholds for what they call IRMAA, which is a increase in your Medicare premiums if your income goes up. So I'll cover all of the annual changes associated with both of those programs here. And then we'll go into the tax law changes that were passed in 2026, and also cover some of the key ones from previous years that are still continuing to impact people. So we'll go through the cost of living increase, what the earnings test looks like, how taxes on Social Security are calculated, and then also cover Medicare premiums for 2026. The cost of living, so every year, the Social Security, they provide a cost of living increase, and it's typically announced October-ish, October, November, in that time frame, and it's based on the CPI, which is the Consumer Price Index. It's a inflation index that the government tracks, and it's not perfect. There's definitely things that it just can't grasp exactly, but it's better than nothing, I guess we'll put it that way. And they've been tracking that for quite some time. There were some changes very early. We're talking 40 years ago, around how they calculated that cost of living increase, but then it's been very consistent since then. So what does that look like for 2026? Now, of course, if you're on Social Security, you would have gotten there's a letter that goes out that tells you what your adjusted amount is for the next year. And the amount that Social Security went up in 2026, 2.8%. And here's just a simple calculation, just some kind of numbers here to show you what that dollar amount would be, looking at what various amounts of Social Security are. This is going back to 1991, and this is showing all of the cost of living increases that we had since then. And you can see 20-year average, 2.7% that we've calculated there at the bottom of the slide. But we've had, in that 2 to 3% range for the last few years. And then during COVID, 2022, 2023, definitely some higher cost of living increases when things were going up. But then we've had some zeros in there. And, essentially kind of what they say is like, well, CPI isn't indicating that there is a significant increase. So Social Security wasn't going up at that time. But those zeros are important, but also the whole cost of living increase is important because it does play a factor in Medicare, which I'll cover here in a few slides. So this earnings test, what this is if you're under your full retirement age. So full retirement age is abbreviated here FRA. And what that is, it's based on your birth year. And if you've logged into SSA.gov or, received a statement, they tell you what your full retirement age is. It's based on your year of birth. And, we're getting closer and closer to where everyone is 67 for their full retirement age. When Social Security was first announced or first created, it was 65. Then in the 80s, they've now bumped up the full retirement age to age 67, but they phased it in. So it went from 65 and 2 months, 65 and 4 months, so on and so forth, all the way up until age 67. Now, you can still claim it at 62 and you can still delay at age 70. So that's still available. So what this means is if, let's say you do claim it at 62. So that is prior to your full retirement age, and you still work. And what they mean by working is you have earned income. So that would be a W-2, from a job, or if you're self-employed, self-employment income. What that doesn't include is IRA distributions. Does not include like passive income streams. So if you have rental homes that are considered passive, if you have a pension, that does not apply. Your spouse's earnings also don't apply to this. So you could be retired or not working and claiming Social Security while your spouse is working, and that would have no impact on this earnings threshold. It just applies to you as the individual on this test. And here's how this works. So for 2026, the threshold is $24,480. And what that means is that if you're claiming Social Security, every $2 that you earn above that threshold, if you're working, $1 in benefits would be withheld or be penalized, I guess, or taxed. However they would, when you file your tax return, is how they how they determine this, or see whether you actually do have to pay some of this back. And that's when that calculation happens. So here, for example, let's say you're 62 and you are working and you made $36,000 and you also claimed Social Security for the entire year. Well, you would be, roughly $12,000 over the earnings threshold. And so you would have $6,000 approximately in benefits that you would have to pay back to Social Security. That's how that would work. Now, in situations where this happens, they do work with people. So they don't, you could just pay it back if you want to, if you have the resources to do so, or they'll reduce future benefits until you've paid that back. They do have ways to help people with that if they weren't aware of this and went over that earnings threshold. So something to be aware of. And then they have a special, what they call a special earnings test for the year that you reach your full retirement age. So let's just say it's age 67. So the year you turn 67, then there's a different calculation. It's $1 withheld for every $3 over $65,160. So, same concept, just slightly different calculation. Once you're past your full retirement age, you can earn as much as you want and claim Social Security. Does not matter. They don't have any earnings threshold past that point. Let's talk about how taxes work. So there is how you pay for your Social Security tax. So that is that's the payroll tax, or the FICA tax, and that applies. They withhold Social Security and Medicare for that. And there's a limit for the Social Security portion of the payroll tax, and it's an income limit, and this is at the individual level. So married couple, each individual would be subject to this earnings cap individually, not as a household. And again, this is only on earned income, not any of the other income sources I mentioned earlier, such as IRA distributions, pensions, even your investment income. So dividends, capital gains, that does not apply to this. And the earnings cap in 2026 is 184,500. So that has, up from 176,000 in 2025. And the way that works, as I mentioned, that payroll tax. So there's, two pieces to it. 6.2% is the Social Security portion. And once you hit that earnings threshold, that 184,000, if you continue to earn more than that, then that portion of the payroll tax stops. The Medicare tax is 1.45%, and that has no earnings cap. So it's all of your earnings are subject to Medicare. And that's, again, these are only earned income sources, not any of the other sources. Let's talk about how Social Security is taxed. So Social Security essentially, it's taxed as normal, as any of your other ordinary income sources, but not all of it applies as taxable income. So let's kind of talk through that, because they do have a special formula to determine how much of your Social Security counts as income. That's really the way to think about it, is how much of it counts as income. And then whatever the amount that counts as income is what flows through to the federal and state tax brackets, assuming your state taxes Social Security. Most states don't. We're headquartered here in Kansas. We're right here on the border of Missouri. Missouri and Kansas do not tax Social Security anymore. That's been a recent development over the last few years. So there is, Social Security is completely tax-free at the state level. And I believe there are 10, maybe 11 states that still may tax Social Security. So the vast majority of Social Security recipients are not paying state income tax on their benefit, but federal income tax may apply. So there's a lot of numbers here on this slide. So here's how this works, and what they call it is provisional income. So provisional income is it's a formula that basically takes your adjusted gross income plus 1/2 of your Social Security benefit plus your tax exempt interest. So when you look at, if you're familiar with the tax forms, adjusted gross income is typically on, it's on the 1040, and you add back in, half of your Social Security benefit. So if your adjusted gross income was $50,000 and you received $20,000 in Social Security, you would add back in 10,000 of that to get, 50,000 AGI plus 10,000, 60,000. And then if you had any tax exempt interest, then you would add that back. So tax exempt interest is interest that is paid by municipalities. So if you have any, what they call municipal bonds, and that would be inside or invested in a taxable investment account. So when you own investments outside of your retirement account, so this is outside of an IRA or outside of a Roth IRA, outside of your 401k, those are all retirement accounts, 403b. Those are, what they call qualified accounts. Non-qualified accounts or taxable accounts, or even like, brokerage accounts. So if you have money in your own name or joint name or a trust, if you've gone through the estate planning process and created a trust, that is, those are taxable. Interest, dividends that are received every year, capital gains, those are all taxed in the year that those are received. And some of that interest, if that interest is tax exempt, if you invest in municipal bonds, it's not subject to federal income tax. Could be subject to state, depending on the state that the municipality's in and the state you live in, but definitely is not subject to federal tax. Now, people might hear that and say, oh, that sounds great. Well, if you look at the interest rates on municipal bonds, they are aware that they do have a federal tax exemption, so the interest rate is much lower. So they have a thing or a concept called tax equivalent yield. And we calculate that, we evaluate that. Does it make sense for someone to own tax exempt bonds or taxable bonds? Because which one pays you the most from an interest standpoint after taxes are factored in? That's really all you care about, is which one gives you the net amount after taxes. So that's what tax exempt interest, where that comes from. So for most folks, I would say, that are listening to this, it probably is not a very large portion, or if much, on your calculation. So when you come up with your provisional income, then what they do is they have these kind of thresholds here. So if you look here on this slide, you've got, if you're married filing jointly, if your provisional income, so it's AGI plus 1/2 your Social Security benefit plus tax exempt interest, if that amount is under $32,000, none of your Social Security is taxed as income. You're receiving that tax free at the federal level. And then as that calculation increases from 32,000 to 44,000, then up to 50% of it counts as income. It's not taxed at 50%, it just counts as income that then flows through the federal tax brackets. And then at the highest threshold, once you're over that 44,000, then 85% of it counts as income, 15% of it is tax free. And you can see the different filing statuses that I have here on this screen, and it all follows the same concepts for for those thresholds to determine how much counts as income. Now let's talk about Medicare. Medicare base premiums went up in 2026. So Part B, that's the amount that Medicare charges, and then you get a supplemental plan to cover the portion that Medicare doesn't cover. And it's Advantage plan, traditional Medicare, original Medicare. Those are really the most common ways that people pay for that secondary policy. Everyone has to pay the Part B, and it could be higher because of this IRMAA surcharge that I have mentioned there. So the amount, as I mentioned, $202.90, and then there's Part D for prescription, which is an additional cost depending on the prescriptions you're on and everything else. So this hold harmless provision. So when I mentioned earlier about the Social Security cost of living increases and why that's important because of the impact it has on Medicare, what this means is that if your increase in Social Security doesn't cover the increase in the Part B premium, and this is just a dollar for dollar, look, then they don't take out more from your Social Security. So, for example, let's say your Social Security increase was $20 a month based on the cost of living increase. And the Medicare, though, the premium went up $30 a month. Now, this is just the standard base Part B. This does not apply to like the IRMAA surcharges. That's entirely separate. This is just if your base Part B, if their cost of living increase that they apply to Part B every year, if that went up on a dollar for dollar basis more than what your dollar for dollar Social Security cost of living increase went up, then they cap it at the amount of the Social Security dollar amount for the cost of living increase. So if you're, back to my example, so if your Social Security went up $20, Medicare went up $30, well then they're only gonna increase the Medicare by $20, so you would get a net zero cost of living increase. Now, that doesn't mean you're just off the hook for that $10. They basically kind of keep track of that, and then let's say the cost of living increase in the next year is now $40 and Medicare only went up 20. Well, because you still owe 10 from the previous year, they're going to add that back in to catch it back up. So that's what the hold harmless provision means. And so in years where it was zero cost of living increase, which there was a few years, if you look back at that chart, then, and Medicare, it, you know, went up those years, may not went up very much, may not have gone up very much, but it did go up. Then, you know, those years you weren't necessarily losing or going backwards on your Social Security check because of this hold harmless provision. Now let's talk about the IRMAA surcharges. So the hold harmless provision is just, again, that's base Part B. IRMAA's not your friend. It's income related monthly adjustment amount. So what this means is if your modified adjusted gross income, so it's adjusted gross income plus tax exempt interest, so that they add back tax exempt interest on this, if that amount is over a certain threshold, whether you're single or married, then you have to pay more for your Part B premium. And it's based on what your tax return said 2 years prior. So your 2026 Medicare premium, or at least the IRMAA calculation, is based on what your 2024 tax return said. So that's an important thing to remember. Now we're always calculating that, and we're evaluating that, and when we're talking to clients about Roth conversion strategies, other tax strategies, we're mentioning there could be an IRMAA surcharge in the future based on what we know today, because these IRMAA thresholds do adjust for inflation. There has not been any significant conversation in Congress about making any sweeping changes to these. So my take is that we're probably going to be living with these IRMAA surcharges for quite some time. Now, the good thing is that it reverts back each year. So if your 2024 tax return, let's say you did have, a large, taxable, income, whether it was a large Roth conversion, you had a large IRA distributions, whatever, your modified adjusted gross income was over the thresholds. And there's several thresholds I'll show here on the next slide. Your 2026 Medicare premium would increase based on, whatever, threshold or whatever bracket you're in, and you would pay that. Then once we get into 2027, it's going to be based on your 2025 tax return. And if your income went down and went below the thresholds in 2025, well, then it resets to the base premium. So you're not stuck with this increased premium indefinitely. It's just on a year by year basis. And this last bullet here is important too, because if you have a life-changing event, so this is common where they were working in 2024, retired in 2025, but they're getting their premium now for 2026 based on their working income in 2024, and you can appeal that and say, I was working, I'm not working now. Here's my income is for 2026. I'm expecting it to be, and if it's below the thresholds, they would just, I've never had anyone lose an appeal based on retirement. So definitely no downside to appealing it in those cases. These thresholds, as I mentioned, they're not talking about significantly changing them, but they do adjust each year for inflation. So here are the brackets. So for a single filer, under 109,000. For a married filer, 218,000. Then you've got the other various filing statuses there. You've got your Part B premium, Part D premium, all that, whatever your IRMAA surcharge would be, which if you're under those thresholds, no IRMAA surcharge. Now, once you get into that first threshold, you can see the additional surcharges that you pay for Part B and Part D. And this is per person that's on Medicare. So it's joint income, it's based on your filing status. And if married couple, both of them are on Medicare, they're both going to pay the surcharges. And then you can see as your income goes up on this left-hand side, the different thresholds here. what the increase in your Medicare premium would be for that year. So it does start to add up pretty significantly as your income increases. Now, again, fortunately, it's a year-by-year calculation. So if you had a very large year and then it went down, you reset back to the base premiums in future years. Now let's talk through the tax brackets too. Tax brackets, there's 7 tax brackets. And what we have here in the US, these are the federal brackets. They're marginal. So as your income increases, the percentage tax you pay on that additional income increases does not impact your previous income, your lower income. It just impacts that additional income. And this has been basically pretty standard. We get inflation adjustments every year. No significant changes to the brackets or to the inflation adjustments in 2026. The big change is the passing of the tax law in the summer of 25 made these brackets permanent. And they're permanent to the extent that Congress would have to pass legislation to change them. These were adjusted back in the passing of the Tax Cuts and Jobs Act in 2017. So taxes went down when that was passed, especially in those lower 3 brackets, lower 4 brackets, went down significantly. And when they passed that, they were set to sunset or expire at the end of 2025. Well, summer of 2025, they made those permanent. And again, it's permanent until Congress decides to change that. So at least there's no set expiration anymore. Now they have to do something about it, which makes things more difficult to change because you have to get enough agreement among all the members of Congress to get things passed. This is the standard deductions for 2026. Single filer 16,100, married filer 32,200, and then head of household here. And the reason the standard deduction is important is because this is the amount that you receive tax-free. So the way the tax system works is that you add up all of your income, on your tax return on that 1040, and that's where that adjusted gross income is. That's everything added up, with any adjustments that are necessary to it. And then you subtract off your deductions. And what's left is your taxable income. And that's what flows through is the tax brackets. Well, if you have certain expenses, such as mortgage interest, state and local taxes, which there was a change to that I'll cover here. If you have healthcare expenses, which is subject to a pretty high threshold, but if you do go above that, and then charitable giving, those are the most common ones, where if those add up, all those expenses combined add up more than the standard deduction, then you claim the itemized deduction. But if you don't have enough of those, which, I've seen some data anywhere it says, call it 95% roughly of tax filers claim the standard. So you can, basically say most people don't have enough because this is a pretty high bar to get above. And these adjust for inflation every year. Occasionally they kind of add a little bit more to it every few years where, part of actually even the passing of the One Big Beautiful Bill was to increase these slightly from whatever the standard cost of living increase was. So you get that tax-free. That's why that's important. So if you had, let's say your adjusted gross income was $100,000 and you're married filing jointly, well, then you subtract off 32,200 off that. And then what's left is what flows through the tax brackets. Call it 68,000, 67,000 is then what's subject to federal tax. Now, this is at the federal level. States have similar, it's all different for each state, but they do have similar kind of thoughts and calculations at the state level. Don't quite always match up, but very, very, very similar. We've got long-term capital gains and qualified dividends. Those have favorable tax treatment as well. So this is, back, when I mentioned earlier about retirement accounts, like these qualified accounts, IRAs, Roth IRAs, 401ks, 403bs, all of those retirement type accounts. Any, dividends, interest, those aren't capital gains, like those don't apply in those accounts, because all the IRS cares about is when you pull money out of those accounts. So when you pull money out of a 401k or out of an IRA and you don't put it back in, you have 60 days to put it back in, or if it's a transfer, it's not, not taxable. But if you just pull it out and use it to live on, to spend, that's taxed as ordinary income. So they don't care about this. All this applies to is your taxable investment accounts, your non-qualified accounts. So it's like, your brokerage account, your just, regular investment account, what's your name, joint name, however you have that structured. And that's where you pay each year as you go on interest, dividends, capital gains, things like that. If you're in the first two brackets, then basically you pay 0% on long-term capital gains and qualified dividends. You can see a different kind of thresholds here for different filing statuses, but when you're in those lower brackets, so for example, and you use up that bracket. So if you've got taxable income of, and you're married, filing jointly, of $70,000. Well, in this, the way they look at this is that you've now got $29,900 of room to basically trigger a long-term capital gain, or if dividends come in, you don't necessarily have a choice on those. Those come into the account of room where those are going to be zero tax at the federal level. So that's great. I mean, that's great. And really where we see a lot of mistakes happen, especially from folks that are, whether it's them doing themselves or they're not working with a, financial planner that's very well versed on the tax side, because, taxes are such an important piece, and it's an ever changing landscape too. I mean, it's just, as much as we'd like things to be easy, they're not, and they're always, always going to be changing here. Using that favorable tax treatment, especially on long-term capital gains, when you do have an investment account outside of your retirement accounts, we call that tax gain harvesting. So you can reset your cost basis and not pay any federal tax to do so. You might pay some at state. So, you do have to kind of run through those calculations, which, again, our planning team, we do that for all of our clients. So, our clients don't have to do that, but we're aware of that. And if you go over it, it's not a cliff. So there's some things that are a cliff, like the IRMAA brackets. Those are a cliff. You go $1 over the bracket, over that threshold, you are now subject to that tax or that surcharge, where the federal brackets are marginal. So it's like $1 over doesn't impact your previous income at the federal tax level. It just impacts that $1. And that's how these work too. So if you have, in my example, 70,000 in adjusted in taxable income, and let's say you have 50,000 in long-term capital gains, well, approximately the first 30,000 would be tax-free, and then the next 20,000 is taxed at 15% at the federal level. So that's how that works. I think that's important to cover there, because that's a thing I see people miss all the time. And that was those favorable tax brackets for tax treatment for qualified dividends and long-term capital gains. That was passed in 2002. That was what they called the Bush tax cuts. And those were temporary at the time. They had an expiration date, and now they were converted to permanent, and now they exist. And there has not been, I have not heard or read much about Congress really debating whether they should continue this or not. This seems to be, pretty standard. So now we're in 2026 now. We're going on 24 years roughly of having this. So while things sometimes feel like there maybe are temporary, when things do pass and become permanent, it's much more likely that they're going to continue. All right, let's talk about the one big beautiful bill. So this was passed in the summer of 2025, and there was a lot of little things that apply to businesses and different kind of class of workers and earners and things like that. And what I'm really focusing on are the ones that our audience would be most interested in, and the ones that people submitted questions on. And it was, really focused on those that are approaching retirement and in retirement, because those are going to be the most, most impactful to you all. So as I mentioned, that those reduction in federal taxes in the bracket, kind of adjustments back at the passing of the Tax Cuts and Jobs Act in 2017, those were now permanent. So we don't have to worry about them expiring anymore. And, the nice thing about that is that does provide clarity on just our calculations and kind of thought process around Roth conversions and, what that looks like. Because, Roth conversions are a very, very powerful tool that people can use to, take money out of a traditional IRA or out of a, 401k, deposit it into a Roth IRA. And that's a taxable transaction. So, you got to calculate what all the taxes would be. But then once it's in that Roth IRA, it grows tax-free forever. And it passes to your beneficiaries tax-free. Now, they have a 10-year window where they have to take distributions out of it, but it's not taxable to them. You're paying the tax. And the nice thing, the way I look at Roth conversions is, yes, there's definitely some thoughts around like how much you should convert, basically how much tax you should pay, because you get to a certain point, especially if you're doing a very large Roth conversion, that you might be paying a lot of tax, and that may not benefit you as much. Doesn't mean it can't. It's more so about, well, what's your view on future taxes? And, most folks seem to think, and I would agree with them, that taxes probably aren't going any lower. Now, are they going to go higher? Who knows? It seems likely that they will, but again, no one knows. But it's hard to envision them going lower. So if we are doing Roth conversions, the nice thing is we're locking in. We know exactly the tax we're paying. So we're eliminating the unknown of future tax policy by any amount that we convert to a Roth today. Now, when someone is in those lower brackets, it is much easier to look at the math on that and be like, hey, that makes a lot of sense. And especially in the years prior to your required minimum distribution, when you're in those lower brackets, because if you have a large enough IRA, those required minimum distributions might push you up into a higher bracket, and you may not ever get into a lower bracket because your IRA balance is such that the RMDs, required distributions, are just going to keep pumping those out. And then the last kind of comment I'll make there on that Roth conversion is, if you're married, it's highly likely that one spouse is going to outlive the other. And what happens is they become now a single filer. And so money, which changes their tax situation, and typically for the worse. So when you've created and you've established all these Roth conversions and you have money in the Roth IRA, you're at least protecting some of the future balance there from maybe unfavorable tax treatment for a single filer, if when that happens too. So a couple of things to think about on that. All right, back to the one big beautiful bill. So another big big benefit to to those folks that are age 65 and older is the bonus deduction for seniors over 65. That's their terminology, seniors. Whether you agree with that or not, that's what they use. So there is the standard deduction, as I mentioned earlier, and there is another deduction for those that are over age 65, which is for a single filer. I think in 2026 it's like $2,050 if you're over age 65 and claiming the standard deduction. If you're married, it's $1,650 for each person that's over age 65. So if you're both over age 65, you double that, $1,650. And that's only available to you if you claim the standard deduction. If you itemize, that doesn't apply. That still exists, and that's been part of the tax code for quite some time. So that didn't change. This is a bonus, so this is in addition to that. It's an extra $6,000 for each person that's over age 65, and it applies whether you itemize or not. So that's one of the key differences with the other age 65 deduction. However, it phases out. You can see here I've got the numbers listed: 75,000 for single filer, 150,000 for joint filer. So as your income increases beyond those dollar amounts, then less and less of that bonus deduction is available to you. And I think it's completely phased out at 175,000 for single and 250,000 for a joint filer. So something to be aware of as well. So like when we do our tax planning, and when we were actually going through our year-end tax checklist, we have this factored in. This did apply in 2025 into all of our analysis, was this additional deduction that for the folks that it applied to. And when we were evaluating Roth conversions and everything else, this now is a factor too, because depending on the size of the Roth conversion and the amount of all the other income sources, it could be completely eliminated. And we wanted to just be aware of that, because this is a unique thing that expires at the end of 2028. So this is just available for a very limited amount of time, assuming it doesn't get extended or converted to a permanent policy. We'll see. There were several provisions that had expiration dates that were in the next few years. The earlier in the webinar, I talked about the campaigning that was going on around no tax on Social Security. Well, that was going to be very difficult to pass. We were talking about that on the podcast. As great as that sounds, and as much as I would think that would be great for folks, it's just the way the trust funds are they're reliant on that tax, because that is that's an inflow along with the FICA tax into those Social Security trust funds, which is what pays for the beneficiaries or the distributions. And as I'm sure many are aware, the trust funds are in a deficit, so more money's coming out than is going in, and at a certain point they'll be exhausted. I think latest data is 2032 to 2034. It kind of varies year to year, but if they were to completely eliminate tax on Social Security for everybody, well, it would speed up that exhaustion of the trust fund. So create a problem sooner. And as Congress, as I think as many of us know, they don't seem to be in any rush to address the situation with Social Security. So to pass something that would make them need to act sooner was going to be, I think, my view was that was going to be a difficult thing to happen. So they didn't. There's still that provisional income calculation, all that exists. So they added this age 65 kind of bonus deduction and positioned it as a way to help people with the tax on Social Security. Anyway, so that's wanted to mention that because we were still kind of getting some questions on that, because I think it was positioned that way, even though it wasn't really. Whether you're on Social Security or not, you still get that age 65 deduction. So it has no connection to Social Security whatsoever. But yeah, I mean, as I was, mentioning, like when we have these kind of favorable kind of tax with permanent reduced brackets, when we have these additional deductions, that just makes those Roth conversions much more, it makes them more attractive. And how do we, factor in our taxable accounts on that, and, converting money to a Roth IRA, and then, knowing that RMDs are coming, down the pipe here, and having to factor all that in. So, and two, it's like when we have these, the nice thing with like that additional lower brackets and making those permanent, it does help with the, with these additional kind of hidden surcharges with Medicare, our calculation on Social Security. There's even a net investment income tax too that applies if your, income is of a certain dollar amount, and then, income or investment income, then it has a surcharge associated with it as well. So, again, it's like, it's taking a cohesive view of everything, which is really the key takeaway. I'm talking about all these little kind of pieces and components, but there's not a, I think it's very difficult for individuals to look at okay, if I pull this lever, all the other impacts that it has, like, well, what does that do to my Social Security? And does it change the tax I pay on that? Well, what about maybe I'm getting favorable tax treatment on long-term capital gains and qualified dividends? Am I pushing myself into a IRMAA surcharge bracket? And was I aware of that? Because that's a cliff. So, again, it's like all these different things all can, one thing can sound good, but it could then trigger all these additional, additional taxes that that may not be aware of. One of the things that was passed as part of the One Big Beautiful Bill was the estate tax exemption was increased to 15 million per person. So, it's 50, individual 15 million, 30 million for a couple. And now it's indexed for inflation going forward too. So that's another key factor. So each year, whatever the inflation adjustment is, they're going to apply that to that estate tax exemption. So that exemption, what that means is that that's the amount that you can pass tax-free, to your beneficiaries, to your heirs, without any estate tax associated with it. And that's at the federal level. Individual states may not follow the federal thresholds. Some states, you have to pay state income tax if your estate is over $1 million. So you may not have a federal tax, a state tax. Sometimes they call it the death tax, but you might have to pay it at the individual state level, depending on where you live. So definitely be aware of that. And the other thing is, like, it doesn't eliminate the need for estate planning. Sometimes I think that might feel that way, but this is just how the tax works. And things to really think about too is, like, if you do have a higher net worth, is to think about, well, how can I take advantage of these limits? And there's lifetime gifting strategy. So what that means is that When you gift money to a, let's just say you gift it to a child, uh, if it's below the annual exclusion, which is for 2026 $19,000, the same as it was in 2025, you don't have to report it. It's not taxable. And if you gift more than that, so let's say you gift to a child $100,000 because you're going to help them with the down payment on a house. What you're supposed to do is you're supposed to claim that against your lifetime exemption by filing a gift tax. There's a form that goes now with your tax return. It doesn't make it taxable because you can give away right now $15 million to the next generation without any tax associated with it. So it all they want to know is they just want to track it against that 15 million. The IRS is basically saying we don't want to deal with a bunch of small gifts. So if they have just deemed this 19,000 and it goes up, a few, every few years it seems to go up like $500. So it's not like a significant amount that it goes up, but they just don't want to have a bunch of these gift tax returns that they have to deal with for small amounts, what they're deeming small amounts. But they do want to know larger amounts, so they've just designated that as the threshold. And again, it's not taxable in the year that it happens or anything. All they want to do is just track it. And then they just want to know, because if you do go over the 15 million, depending on how much money you have, now, they're going to not like that, but at least, that's how the process works. And that annual exclusion, it applies to each person in the household. So if you're married, and you have a net worth of $15 million, well, it doesn't matter your net worth, but I mean, you can give $19,000 to each one of your childs. Each spouse can. So you can basically double it. And then if any of your children are married or have grandchildren, you can give it to each of them. So, I mean, that 19,000 can get stretched in a lot of different, different ways, depending on what your objectives are. So, but yeah, as I mentioned, it doesn't eliminate the need for estate planning, because estate planning, even if you're not subject to estate tax, is more about, making it easier for your beneficiaries to inherit the money, and making sure, and the assets, and making sure that the assets are handled in the way that you want them handled. And that's what proper estate planning does primarily. It's efficiency, avoiding unnecessary, probate and just, penalties or hang-ups with, courts and legal systems and everything else. With proper estate planning, assets transfer very effectively and very efficiently in, when someone passes away. So that's really a big factor too. And there's always the fear that estate threshold could go down. And that's where that lifetime gifting, kind of the concept is, well, if you're worried about it going down, if you take advantage of what the rules are today, they don't retroact and say, okay, well, you went above it. It's like, no, I was under the rules at the time. And, you've captured that. So, if you have that issue, again, we're happy to talk to you about that. One of those itemized deductions that I mentioned is state and local taxes. Well, part of the passing of the Tax Cuts and Jobs Act is they capped the deductibility of state and local taxes to $10,000. So prior to that, you were able to deduct all the state and local taxes that you paid against your federal taxable income to reduce your tax bill. It wasn't the tax you paid at the state and local didn't apply to your federal tax. It just reduced your federal taxable income. And with the passing of the bill last year, they increased that to $40,000. Now it's $40,400 in 2026, but it does have an income phase out range. So if your income's over $500,000, then that begins to phase out. So, again, another thing to be aware of. The healthcare subsidies, ACA subsidies. So the enhanced ACA subsidies, that was kind of part of the COVID, one of the, I think it was the CARES Act. It may have been a different one, but they enhanced the subsidies for folks that are purchasing health insurance on the healthcare exchanges. This doesn't apply. Once you're on Medicare, this doesn't apply. But if you're on the exchanges, so it reverted back to the way it was. So this is, not didn't make it worse, just reverted back. And so now there's a cliff, another cliff where if you're relying on those subsidies or you're looking at those, if you're barely over this 400% of the federal poverty line, then you don't get any subsidy. So, be very aware of what that dollar amount is. It's $62,000 for a single filer, $84,000 for a couple, and it's based on how many people are on your health insurance plan. So if you have more than two, then that number goes up. So, just be aware of that. And also for the calculation for that, because they look at that, it's the federal poverty line is it's modified adjusted gross income. So it looks at if you're on Social Security, 100% of your Social Security, not provisional income, which is only half. Again, confusing how some of this stuff comes together. Part of the Secure Act 2.0 was changes to the required minimum distribution age. It's being pushed from, it was 70 and a half for the longest time. Now it's 73 and then increasing to age 75. Just want to point that out because we're still kind of in that in that phase in range for folks. It doesn't impact QCD. So if you're processing any qualified charitable distributions, that is the ability for you to distribute funds directly from your IRA to a charity. That's available to you once you're past age 70 and a half, you can do that. And that still applies. And, for most folks, this change, people are taking distributions out, but really where it helps a lot, where we've talked a lot about Roth conversions, because if we're not forced to take out distributions out of the IRA, it just gives us more flexibility on how much we can put into a Roth. Because once you begin your RMDs, you can still convert to a Roth IRA. It's just the amount of the required distribution cannot go in the Roth IRA. So the IRS does not allow that. So if your required distribution is $100,000, that has to come out and it cannot go into a Roth IRA. Any amount above that $100,000 that you take out of your IRA can go into a Roth IRA, just not the amount of the RMD. So important to understand that. And then we've got enhanced catch-up contributions. So these are for folks that are working and saving inside their retirement plans. Once you're over age 50, the IRS allows you to put in more into your retirement plan. And there was some changes to that back with the some tax bills over the years. So you can see here the various amounts for 2026 based on your age, 50 to 59, and then 64 plus, because they have this 3-year window where you can do more. It's kind of, again, confusing unnecessarily why they have that, but that's how they structured it. I think, but the key thing is for 2026, the Secure Act 2.0, what they changed, which will impact, I think, more people, is if your FICA wages, so when you get your W-2 for 2025 and you're still working and you're over age 50, if that amount's over $150,000, then any amount that you put into your 401k that's designated as a catch-up will automatically have to go into the Roth bucket. You don't get a choice. So basically what the IRS is saying, or what Congress did by passing this, is they're like, we're going to allow you to put the catch-up in, but we're going to make you pay income tax on it today. I mean, it's not necessarily the end of the world. It's just something to be aware of. And then the QCDs, I mentioned those charitable distributions, those passing with the Secure Act 2.0, they are now indexed for inflation. So the amount was $100,000 that you can, that's the limit that you can distribute out of your IRA at age 70 and a half at the time. And now it's 111,000 with the cost of living increases that you can distribute out of your IRA. And that's per person. So, again, married couple each have their own IRAs and they're each over 70 and a half. They each can, distribute up to 111,000. It doesn't, there's no minimum. It's just, that's the maximum. Well, I talked a lot, and I know I'm actually slightly over the time here, so I appreciate everyone joining us today. And again, appreciate your questions that you all submitted. Very helpful. We'll cover future questions too on our future podcast episode. But again, we talked, like I've mentioned throughout the webinar, like the important thing here is it's to have a plan and just understand all these moving parts. And you may not care about understanding all the moving parts, but at least work with someone who does, because that is the important thing, is to really look at this overall tax picture and how does that fit in with my investments and the different types of accounts I have and where do I pull distributions from, and everything. There's a lot of things going on, and the stakes are high. You cannot make a mistake, or it can be very, very costly, and some mistakes are very difficult to recover from. So again, appreciate you all for joining us, and we'll follow up with the folks that had questions. If you'd like, again, follow us on our social channels, Facebook, LinkedIn, YouTube, your favorite podcast player. If you'd like a copy of the book, reply to any emails that you receive from Keen Wealth and ask for a copy of the book. That's, about as easy as we can make it there. And, again, we will see you next month for our next webinar.